What if Mark Carney's refusal to bend to Donald Trump was never just about dignity? What if it was about preparing a financial countermove that could shake Wall Street itself? Because new analysis suggests that Canada is actively exploring strategies to decouple the Canadian dollar from its dependence on the US dollar. And that shift could put $340 billion in US Treasury bond holdings at risk. This is no longer defensive economics. This is structural leverage. For decades, Canada's currency policy has been tied to Washington. The Canadian dollar has functioned within the gravitational pull of the US dollar. That assumption is now being challenged. According to financial analysts and central banking sources, Ottawa is examining pathways to reduce currency dependence on the United States. This includes diversifying foreign exchange reserves, expanding trade settlement in alternative currencies, and potentially restructuring Canada's massive holdings of US Treasury bonds. Canada currently holds approximately $340 billion in US government debt. That figure is not symbolic. It represents one of the largest foreign creditor positions in American public finance. If Canada begins reducing that exposure, even gradually, the consequences for US bond markets would be measurable. Yields could rise. Borrowing costs for the federal government could increase. Market confidence in the dollar's dominance could weaken. This is not speculation. This is how sovereign debt markets function, and this is why the timing of this exploration matters. Let's examine the sequence. For months, Donald Trump has deployed tariffs, threats, and public pressure against Canada. He has weaponized trade policy. The assumption behind that strategy was clear. Trump believed Canada had no alternatives. He believed economic dependence would force compliance. That assumption is now being tested. Because while Trump escalated, Mark Carney prepared options. While Trump threatened, Carney diversified. And now, Canada is exploring the one move Trump cannot ignore: a shift in currency strategy that directly impacts American financial stability. This is not retaliation. This is risk management. Canada is not threatening the United States. Canada is reducing its exposure to political instability in Washington. When a trading partner becomes unpredictable, when agreements are disregarded, when economic policy becomes a tool of personal leverage, prudent financial management requires diversification. That is what Ottawa is doing. The question is not whether Canada has the right to restructure its reserves. The question is what that restructuring signals about confidence in U.S. leadership. If you value serious financial analysis and accountability in international relations, subscribe to Canada Today. We track the decisions that shape markets and test alliances. The mechanics of decoupling are complex, but the principle is straightforward. Canada would gradually reduce its reliance on the US dollar as the dominant reserve currency. This could involve increasing holdings of euros, yen, yuan, or even gold. It could involve shifting trade settlements with key partners into non-dollar currencies. It could involve coordinating with other US allies who are also questioning dollar dependence. None of these moves would happen overnight, but the signal would be immediate. If Canada, one of the closest US allies, begins publicly diversifying away from the dollar, other nations will notice. And if other nations follow, the structural advantage that has sustained American financial dominance for decades begins to erode. Wall Street understands this. Financial analysts have already begun modeling the impact of large-scale Canadian reserve reallocation. If even a fraction of Canada's $340 billion in US Treasuries were sold or allowed to mature without reinvestment, bond prices would fall, yields would rise, and federal borrowing costs would increase. This is not abstract theory. This is market mechanics. And the fact that Canada is even exploring this option represents a shift in strategic thinking. Trump's approach to Canada was built on the assumption of leverage. He believed tariffs would force compliance. He believed threats would produce concessions. He believed economic pressure would weaken Ottawa's position. Instead, the opposite is happening. Canada is not weakening. Canada is repositioning. And that repositioning includes the one financial tool that could impose real costs on Washington: the restructuring of sovereign debt holdings. Mark Carney has not made public threats. He has not issued ultimatums. He has not engaged in the kind of political theater that defines Trump's strategy. Instead, he has quietly built optionality: diversification agreements with Europe, expanded trade with Asia, strengthened currency swap arrangements with key partners. reduced reliance on American financial infrastructure. Each of those moves increases Canada's ability to withstand economic pressure from Washington, and each of those moves reduces Trump's leverage. This is the difference between reactive politics and structural strategy. Trump reacts. Carney prepares. Trump threatens. Carney builds alternatives. And now, the result of that preparation is becoming visible. Canada is exploring financial decoupling, and that exploration alone shifts the power dynamic. The institutional response inside the United States is already emerging. Financial analysts are warning that alienating major creditor nations carries risks. Economists are noting that dollar dominance is not automatic. It requires trust. It requires stable policy. It requires predictable leadership. When those conditions erode, so does the structural advantage. Republican lawmakers who have supported Trump's aggressive trade stance are now facing questions about long-term consequences. If Canada reduces its Treasury holdings, who fills that gap? If allied nations follow Canada's lead, what happens to demand for U.S. debt? These are not hypothetical concerns. These are questions being raised inside Washington's financial policy circles. Trump built his economic strategy on the belief that America's size and market access would force other nations to accept any terms. That belief ignored a fundamental reality. Financial interdependence cuts both ways. Yes, Canada depends on access to U.S. markets. But the United States also depends on foreign capital inflows to finance its deficits. If those inflows slow, if creditor nations diversify, if confidence in dollar stability weakens, the cost falls on Washington. Not symbolically, literally, in the form of higher interest rates, reduced fiscal flexibility, and diminished financial influence. Mark Carney does not need to announce a dramatic policy shift. He does not need to publicly threaten bond sales. The mere exploration of decoupling strategies sends a message. That message is simple. Canada has options. Canada is not locked into dependence. Canada can manage its financial future independently of Washington's political volatility. And if Trump continues to treat Canada as a pressure point rather than a partner, those options will be exercised. This development reframes the entire narrative. Trump presented his tariffs and threats as strength. He framed economic pressure as leverage. He claimed he was defending American interests. But if that pressure results in Canada restructuring $340 billion in financial exposure away from the United States, then the policy did not strengthen America's position. It weakened it, because financial decoupling is not reversible with a tweet. It is not negotiable with rhetoric. It is structural, and once it begins, it accelerates. Wall Street does not operate on political loyalty. It operates on risk assessment, and the risk that Canada, a stable, credit-worthy ally, is actively exploring currency decoupling because of political instability in Washington is a risk that markets will price. That pricing may not be dramatic. It may not be immediate, but it will be real, and it will compound over time. Trump attempted to leverage Canada's economic dependence. Instead, he may have triggered the exact opposite, a strategic recalibration that reduces that dependence and shifts financial risk back onto the United States. He attempted to project strength through tariffs. Instead, he may have exposed structural vulnerability. He attempted to force Canada into compliance. Instead, he gave Canada a reason to build alternatives. This is not strength. This is strategic failure. If financial decoupling proceeds, the consequences will extend far beyond U.S.-Canada relations. Other allied nations will observe that economic pressure from Washington can be countered with structural diversification. They will note that dollar dependence is a choice, not a requirement. They will recognize that reserve diversification is not an act of hostility. It is an act of prudence. And if that recognition spreads, the foundation of American financial dominance weakens. Not because of external aggression, because of internal miscalculation. Mark Carney has built a strategy that does not require confrontation. It requires patience. It requires preparation. It requires letting Trump's own actions produce the consequences. And those consequences are now emerging. Canada is exploring decoupling. Wall Street is pricing risk. Washington is facing questions it cannot easily answer. And the power dynamic that Trump assumed he controlled is shifting. Donald Trump tried to weaponize trade. Mark Carney is preparing to restructure financial exposure. Trump imposed tariffs. Canada is exploring currency independence. Trump demanded compliance. Canada is building alternatives. The bridge was supposed to be leverage. The tariffs were supposed to be pressure. The threats were supposed to force surrender. Instead, they may have triggered the one move that undermines American financial stability. Not through aggression, through prudent risk management. If you value serious analysis that tracks power, influence, and financial strategy, subscribe to Canada Today. Because sometimes the most important moves are the ones made quietly, and sometimes the greatest risks are the ones created by overconfidence. This story is not over, but the direction is clear. Canada is decoupling, and Wall Street is watching.